Hi, Kelly Eckholt here to update you with the key events of the week. So this week the big event was the all-important March quarter CPI. Markets were expecting an increase in the CPI by about 4% for the year to March. That's a bit ahead of what the Reserve Bank was expecting when they updated us back in February, where they thought that the CPI would be going up by about 3.8%. As it turned out, we got an outcome which was pretty much in line with market expectations, but it reflected some very divergent underlying trends. In particular, domestically orientated inflation really shot the lights out and came in a lot higher than expectations at 5.8% for the year, balanced off by relatively low imported inflation, which went up by only 1.6% for the year. We can see the impact of these divergent trends in the prices of a lot of the goods and services that Kiwis like to buy. For example, on the imported side, we saw new car prices fall by 4.2% in the March quarter, and we also saw the price of AV equipment fall by 12% in the March quarter. So that's obviously good news for people buying those things. But on the domestic side, we saw the cost of accommodation booked for overseas onshore go up by 6.8% in that March quarter, and that's the cost that those Swifties had to pay to go and see those concerts over in Australia a couple of months ago. And also the cost of home insurance went up by 6% in that March quarter. And of course we can't forget that rents are running at about a 4.7% annual rate for the year to March, which is the highest level we've seen since 1999. Bottom line here is the Reserve Bank is not going to be at all happy with the very high level of domestic inflation, and hence that's why we continue to believe we're not seeing interest rate cuts here in New Zealand until 2025. I'll be back to update you again next week.